What's going on, guys? So today I'm excited. It is that time again, portfolio um, updating time. So I'm excited because I finally get to close out a long held position that we've had in Seagate here. Um, as you can see, we have an average purchase price of roughly $30.49. That stock price has now gone to $45 and change. So roughly, almost 50% gain on that one. So I know I'm going to definitely sell, but whether or not I will sell all of these shares, um, I don't know. So that's what we're going to be looking at. Sunlight Financial, we went through this one last week. This one is still a sale, but there's really nothing that we want to replace it with. We'll look briefly at that again. Equity real estate or equity residential has really taken a big hit with rates rising, rents are falling in New York, San Francisco, all of those high net worth locations that they deal in. Those rents are still falling. Sooner or later, those rents will hit a bottom, and then and we'll start to see some normal earnings and profit come out of here. But for right now, um, that stock is still falling. So at a 7% gain, if we buy more, we'll definitely want to do that today. The next option we have is to buy some more Exxon Mobil, but at only a 1% gain if we buy. I really don't think it's necessary. We'll let this come down a bit more before we buy in. Right now, I believe the price is somewhere around 83. We have a purchase price of 86. This price has really been up and down lately, especially with talk of border taxes and things of that nature. Rex Tillerson, the ex-CEO of ExxonMobil, is now going to be Secretary of State. So I plan to see some good things come out of that. There's also climate talks about ExxonMobil knew about climate change and all this kind of crap. I don't think anything will come of that, especially being that Rex is Secretary of State, even though he can't be out front about it. Who knows? With this administration, maybe he will. Maybe he'll just get in front of the camera and say, "Listen, leave Exxon alone." Who knows? We'll see. But I don't really think anything big is going to come of it. If anything does, I'm sure they'll settle for a little bit of money and everything will be done. This current quarter, they had something like $9 billion in profit, and $2 billion of that was a one-time write-off charge for some assets. So, I mean, those guys are doing okay. We'll just let the price come in a bit. If it gets too low, we'll buy some more. Otherwise, I'm fairly sure we'll be back up to the $90 range very fairly quickly. All right, the next one we're looking at here is McDonald's. This one has really caught a little bit of wind. I think right now the price is somewhere around 123 and change, close to 124. So right now we can sell this, but again, this is something that we looked at last month, and there was really nothing that we wanted to replace it with. I think the options were maybe Best Buy and Lilly, LLY, I believe is the name of the company. LLY is the symbol for sure. So I'll briefly look at that again, but I don't think I'll change my mind or anything on it as of right now. So the big important thing here is definitely selling either all or some of the Seagate, and then purchasing some equity residential. So let's take a quick look at the past month's performance. Let me hide this, make things a bit more easier to see. All right. Wow, this thing. All right, here we go. So Nucor has really been on a tear lately, man. It really has. And look at this. It dropped pretty big in February. Um, but makes sense because it has really been flying high. Looks like it still beats out the rest of the names in the bunch for performance over the long haul. Dow, pretty good. I like Dow. Um, Weyerhaeuser is where we are. This is lumber. And it's all about housing right now in Japan. It's all about housing in the States. There wasn't very many forest fires or anything like that to harm production. But also because there wasn't many forest fires, it also meant that there was nothing to hurt supply. So there's a lot of supply. Demand is picking up, but still not great. But we're going to stick with Weyerhaeuser for the time being. The stock price doesn't move a whole lot. It typically stays within a range of $30 to $32. I saw it go down to 29 a long time ago, but never low enough for me to buy any more. And I collect the dividend while that goes on. I was looking at the options on this thing, and the options are a year out. Which isn't a bad deal, you know. You can pocket, $90, which is about 3 shares of the stock for a 1-year option at $35 or $37. So not a terrible deal to hold this for a year and collect the dividend, but not something we want to do at the moment. Okay, so next we have potash. Looks like it's been struggling quite a bit over the course of over a year or so. All right, next we have our Best Buy, our McDonald's, International Paper, Las Vegas Sands, and where's my LLY? Oh, you know it? I don't see it. Oh, L Brands. That's right. It was L Brands, not LLY. L Brands. That's right. Victoria's Secret. Now I remember. So yeah, it was a toss up between Best Buy and L Brands, and I didn't go with either because the dividend was so small for these, and McDonald's is where we stayed. So I'll look at that again just to double check. But looks like McDonald's on average is up there. It's number 2 spot as of right now. L Brands has been hurting. It's really taken a huge loss this month, and a lot of that has to do with the fact that no one believes in retail anymore. Those retail stores, just no one believes it. No one believes that they're making the money that they're making. No one believes that they can continue to really stay in business. Honestly, everything is going to the internet. So as a condition, looks like consumer cyclicals for February was actually positive, and certain it has a whole lot to do with Best Buy, probably Christmas numbers. I don't know. It's like basic materials was up almost a percentage point. It's not bad. Okay, so now to our defensive stocks, the consumer durables. Procter & Gamble, best performance out of the bunch. I'm going to have to take a look at that. I didn't notice that last time I looked at this. Altria, Kellogg's, Philip Morris. This is what we're in. Coca-Cola, European Partners. Look at this, man. 6% last month. 6%. But that 6% came from being way down in the previous months. So even though it has come back quite a bit, it's been way down. But again, never really low enough for me to buy any more. Let's take a look at that. CCE. Yeah, we have it at 51.14, and the price is somewhere around 30 something, and you got to add the 14 to it. So it's can't buy it, can't sell it. So we're holding on. We're collecting a smaller dividend, which I kind of hate, but the reason for that is because we wanted to get out of the higher dividend defensive names due to the interest rates rising. So we'll stick it out, and we'll collect those dividends until then. Let's see, anyone else? Looks like Reynolds American, it's another cigarette company, did pretty good. Target, see again, man, those retailers, horrible. I mean, if I wanted to make money shorting a stock, I would definitely get into a retailer for sure. I mean, I may even seriously look into doing that in my personal account, because yeah, I don't see that turning around anytime soon. I hear Macy's is for sale now. Who's gonna buy Macy's? Macy's has to stay around. There's no way we're gonna lose Macy's, are we? So anyway, Walmart was down this month, but the sector on its own though was up 2% in February, and that's primarily due to the fact that we had some what's the word I'm looking for? We had some people running to safety, afraid that the market might fall off, and so they're getting into these companies that have these higher dividends because they know that they'll be safe in these companies. And so you can see January and February, everyone's running into these things. The crazy part about it though is that volatility has been so low. So low. I think the VIX is like at what, 11? There's not a lot of volatility. There's not a lot of fear in the market, yet and still we see people running to these defensive names. I mean, Procter and Gamble, Altria, I mean, Philip Morris, Coca-Cola. These aren't large profit margins. These are cigarette. I mean, these are cigarettes. Reynolds American, Philip Morris, Altria, they're cigarette companies. There's Marlboro. I can't think of the other cigarette. There's Newports. There's Black and Milds, right? I mean, what are we saying? I mean, are more people smoking now? No, I don't think so. I think it's because people are coming into these companies because the prices doesn't move very much, and you have a fairly large dividend that keeps you safe when things are hot. So I'm curious to see if maybe this is the highest out of the entire market for sectors. All right, let's see. So energy, Chevron, best performance, but energy, my goodness, energy has taken a hit. I mean, on average, we're talking about being down 3.6%, and that's why ExxonMobil is down to 83. So it's the entire sector. It's the entire sector. The only company that did well, Energy Transfer Partners, and that is because of Trump and the pipeline out of the Dakotas. That's what that's about. And I have to mention, just to give myself a pat on the back, I actually own just one share of Energy Transfer Partners because I had 101 shares and I had an option called away from me for 100 shares. So I still have one share. So I had maybe what? I'm curious now. Let's go see what percentage of Energy Transfer Partners is the portfolio here. Oh, you know what? It's not Energy Transfer Partners. It's Energy Transfer Equity. It's the parent company for Energy Transfer Partners. Ah, how can I forget that? And you know what? I don't see them here. You know why? I think because they're listed as a utility. I gotta go check that. But anyway, that's what that is though. That's the Dakota pipeline, and that's definitely going through. And those guys pretty much own that thing. Well, they own all the rights to the money coming out of it. But as a whole, energy sector down almost 6%. So if you want to look at it that way, well, look at these guys, 7%. I think this is Magellan. I forget the name of this company, but MMP I haven't really looked at them very much. They don't pop up on the radar very often, but they're definitely on my radar today. So I'll look at that a little bit. But ExxonMobil looks like it fared really well. I mean, out of all the companies here in this energy complex here in this sector, ExxonMobil really did well. You know, these are pipelines. That's a pipeline, okay. But the rest of these guys, most of them anyway, are going to be your oil companies, your refiners, things of that nature, and they all took a hit. But ExxonMobil fared fairly well, so I feel good about holding ExxonMobil in the portfolio for February. So when the rest of the sector is up, I'm sure Exxon will be back to 90 or knocking on 90. All right, so financial sector. This has been the boom. Everyone knew it was going to happen. There was no question about it. When they started talking about raising rates, banks and financial companies were the thing to buy. There's just no questioning it. And they have delivered. They have delivered. You know, despite everyone knowing that it was going to happen, they delivered. And people were nervous about that because typically when everyone knows something is going to happen, it kind of gets bought early and then just kind of sits there, right? But these things have been grinding higher every day. And so we're in Sun Life Financial, SLF, outperforming the entire sector. That makes me feel good, you know. When you pick a stock that outperforms the sector, it's like, okay, well, I think I did my job, right? It's not going to happen every month, I'm sure, but it is so this month. For the month, 2.65%. Really, you know, looking at all these companies here, we'll leave Aflac out. That's a different story. On average, they're going up 5%. 5% on average. And Sun Life is only at 2.65. So even though, you know, over the course of, you know, like I think a year and a half maybe, it's outperformed. It's kind of underperforming right now. But I think the financial sector is going to be number one, and it looks like consumer durables is number two. So that says a lot. It says a lot. And looks like health is a very, very close second. Let's see here. My goodness. Look at Baxter. Merck. Wow. There's our Lilly. That's what I got them mixed up. LLY. I got them mixed up. All right. So, all in all, we are here in Pfizer. Pfizer is not performing as well as its peers, but I'm happy with Pfizer for now. For now, I'll say, decent dividend, lots and lots of cash, and I'm gonna take a look at what that is now. Kind of curious. I know I need to update this thing. Let's see here. Let's blow this up. Let's see. Health. See where we are. But the last time I looked, I mean, they had all kinds of cash on hand. And they tried to buy out Allergan, and Obama's government would not allow it. So let's see what happens in mergers and acquisitions under Trump. Let's see what happens, you know. Looks like they're in line with the PE, so not a very expensive stock at this point. Baxter has never really been on my radio. I mean, my radar. I got to figure out what these guys really do to have a PE so low. Johnson & Johnson, I know, is not really a health company. even though they do some drugs, for the most part, they're a health retailer, which is why they're not going to be the same multiple as these guys here. But yeah, I mean it's cheaper than Merck, not by much, but cheaper for sure. All right, net profit, yeah, way down, almost 50% versus Merck up 50%. Current ratio, yeah, looks like Merck got them there. Look at this though, cash. See, that's the thing that interests me about this company. They have so much cash on hand, and they have to do something with it, right? And everyone is just around licking their chops, saying, "How about you pass some of it this way?" You know what I mean? As an investor, I would love to see just a special cash dividend. $2 a share, $3 a share, $5 a share. Send me some cash, right? But what's more likely to happen though is that they're going to buy something. They're going to buy off something, and with this talk about drug companies lowering their prices and things of this nature, I'm convinced that what's going to happen is some of these smaller companies, maybe even a large company that's maybe struggling with drug pricing, can be bought up by the likes of Pfizer, which hasn't really been under the microscope for this kind of stuff, and can snatch that company up, okay, boost its margins, right? But at the same time, do away with all the headline risk, right? Because once Pfizer buys out that company, well, now we don't have to really worry about it because it's under Pfizer's umbrella and not so much on its own. Maybe it won't get talked about so much. That's possible. The other thing here is looking at the assets liability. Looks like everyone in the sector is either getting rid of assets or piling on liabilities. I can be happy with Pfizer's number here. Of course, going forward, I want to see it increase, but for right now, we're okay. Cap cost is almost nothing. Let me see if there's even a decimal here. Yeah, there, and just so you understand, the cap cost is literally their interest that they're paying on their loans, and either they aren't paying any interest at the moment, or they actually do not have any outstanding loans that are currently due. All right, it could be one of those two. The beta. Here's why I love this company. The beta is beautiful. This beta is calculated based upon how well the stock reacts when the market is in a downturn, and that's why I like Pfizer, because it gives me that security that I want in this sector. Okay. Have an estimate on it of $35, as high as 40, can go down to 26. If Pfizer gets to 26, I'm definitely buying. There's no question about that. I think right now it's hovering right around 31, so not bad at all. 21% off its high, 20% off its low, so it's right in the middle, literally. Of course, this is the issue. Typically when you have a stock that performs so well during a downturn, it performs poorly during an upturn. And right now, the market is trending higher, and so it makes sense that Pfizer may not do as well as some of its peers. But again, that's why we own the stock, is for the downturn. The other thing that bothers me just a bit, and I don't have the short interests here on this chart, but what you do see here is what's called a down move, okay? And what that means is, it means that whenever there's a spike in volume, okay, the stock tends to move down 38% of the time. And what that means is that when there's a lot of activity, it's because there's a lot of people selling. So you have more people selling this stock than you have buying this stock when there's a lot of activity. And it seems to be the case pretty much for all these companies except for Baxter down here. And so again, I'm gonna look into Baxter and see what's going on there. So 38% versus 8%, it's maybe perfectly normal for the sector, but it does worry me just a little bit that people are betting betting this thing down. All right, so anyway, 2.56 consumer durables was 238. So yeah, so healthcare actually came in fairly strong second. And it looks like had a lot to do with maybe Trump getting into office, right? Okay, next one, the industrials. Forever I have wanted to get into paychecks, but I can't get into it because GE just won't give me an opportunity to buy more, and it gets ever so close to me being able to sell, but not quite. So again, GE, one of those companies, great company, been around for at least 100 years, at least, and it pays dividends on time, every time, no question about it. The stock price barely moves. I mean, I bought it at, let me see, I bought this thing at, no. Yeah. No. There we go. Come on. All right. Yeah, see, I bought this thing at 27. That was a steal, man. That was a steal. So happy I got that. And look at this. See this? Now, this number is basically, what it means is if I were to purchase this stock right now, I will actually lose 30%. Okay? But what's important about that, though, is this. See this? I can sell Sun Life Financial. I'm at 31. I can sell Seagate. I'm at 48. GE, I'm at 30, but I can't sell it. I can't sell it. Why? I can't sell it because of this. That's why. For the most part. Because when I got this thing, transferred it in from a personal account, and I had to literally buy more shares, and I only own 5. Can you believe that? Can you believe that? I own 5 shares, and I had to buy more. Well, I'm sorry, I own like maybe 2 shares, and I had to buy more, and so my commission was $14, $7 each time I bought it, and this commission is what's keeping me from selling GE. So, but, I'm going to remain disciplined. It's a great company. I'm going to stick with it until my profit rises above my commission plus a specific percentage gain. I'm just not going to sell. And my program won't allow me to. It won't do it. All right. So that's that. But going back though, GE is decent. It's decent. I think it's like what, 4th or 5th or something like that in the industrial sector. But it's a good company. I like GE personally, and it's going to be around for a long, long time. They are trying to turn some things around. They've gotten back into energy. They're building wind turbines. They're doing some things that I really like. They're really trying to become a technological company versus a industrial company. So they're doing some good things, but my goodness, look at this, 6% down in February. That's tough. But again, nowhere near where I bought it at. So I'm happy about that. EMR never really been on my radar, and this thing just skyrocketed this past month. Uh, Paychecks, no, waste management is actually best performing in the sector. And it's you know what, waste management has been doing well for a long time. I don't know a lot about the company other than some of the numbers that I've seen, but they've been doing well for a long time. Paychecks is something that constantly comes up. I mean, Paychecks is so much on my radar. It constantly pops up on this and that and this and that. I've had no choice but to look at it. And, you know, when you have the labor market where it is, and you have talk of adding more jobs, and you have talk of inflation, I mean, that is perfect for Paychecks. Perfect. Because all they're going to do is they're going to sign up more companies that's paying more employees, and they're going to charge them more to do it. I mean, you can't beat that. You can't beat that. And they pay a decent dividend, right? As a sector, though, 0.11%. So we'll have to see what's going on. You know, people talk about, you know, shovel-ready jobs with Trump and building infrastructure and stuff like that. Who benefits, right? Who benefits? The industrials. The industrials benefit. The steel companies, the copper, you know, the concrete, all those types of things. So you know, we'll see what happens. But we like GE where we are. We really do. All right. Real estate. This one has just been beat up, man. It's been beat up. And without looking at this, I'm gonna bet you DLR is doing. Look at this. Woo, 8%. My goodness. DLR is killing it. Killing it. This is they're in real estate, all right, but they're in real estate for server farms. All they do is they buy out these big warehouses to house servers and hard drives for cloud computing. I mean, best performance by far. The rest of the sector, as they're hurting, man. They're hurting. Real estate is getting hurt. Yeah, they're down on average for February. On average, they're down. But come on. We are currently in equity residential, and they're invested in condos, apartment buildings, and the like in San Francisco and New York, and I believe Chicago, and a few other high-end places. And yeah, I mean their rents are falling. It's hard to get tenants in at higher rates. Silicon Valley is kind of cooling off. It's not the hotbed that it used to be. So it's only normal. We're gonna see a slide in the price, which is fine, but it will bottom out. It will normalize. I mean, it's a huge company, not going anywhere anytime soon. And I mean, what are you going to do without residential housing, right? I mean, come on. However, with all that being said, I'll have to take a really good look at digital realty. I forget what the L stands for. It's digital realty, I know though. So the sector on average 0.73, nothing to really talk about. This is the tech sector, and this is this is weird to me. Look at this. The sector itself down almost 4% this month. Almost 4%. Who did this? Qualcomm did this. Qualcomm. Look at this. Down 18%. Now Qualcomm does a lot of chips and circuit boards and whatnot for phones and things of that nature. Down 18%. Now, again, Qualcomm's not really on my radar, so I don't know a whole lot about what's going on there. The last time I did any kind of research on Qualcomm, honestly, was I did a research paper for my undergraduate degree on Qualcomm. Back then, Qualcomm was in the $80 range. And even then, I told my professor the stock was way too expensive. I told him, I said, I know I did my presentation on Qualcomm, but I wouldn't buy it at this price. Yeah, I still made a good grade. But yeah, so, but Seagate though, what we're holding, 17%. On average, not the best performer in the sector. And, you know, a lot of that has to do with the fact that this particular stock is fairly volatile. You know, I purchased it for that reason. It has very wild swings up and down, which is kind of what I wanted. But the cool thing about Seagate is it has these wild price swings, but their dividend is like super high. Like when I got into this thing, the dividend was like 7%. Now the dividend is somewhere around 5% because the price has gone up so high. So, you know, we have to start looking at, okay, so maybe do we move into Microsoft? Do we move into Intel? Do we move into Texas Instruments? You know, I believe CA is actually the top pick for the portfolio actually right now. So we got to really dig in and do some work tonight on what we're gonna do as far as our tech stock. But for right now, man, I'm really happy with Seagate. It does bother me. Well, I shouldn't say bother me. It does scare me a bit because all it takes is someone to say, "Oh, well, you know, we aren't selling computers like we used to," or something, and next thing you know, people are selling Seagate hand over fist, right? I mean, so we'll have to do some homework. All right, next is the telcos, telephone companies: AT&T, Verizon, Bell, Telus, CTL. Looks like AT&T best performing. Verizon, yeah, I don't know how Verizon even stays in business. Anytime I see anyone with a Verizon phone or Verizon service, I just ask them why. Like, what was the reason for that? They're expensive as hell. They don't have any special phones to speak of. What's the point? I don't get it. You know, I really don't. So yeah, I mean, I not happy with Verizon, but Verizon has a great dividend. Great dividend. It's just I don't believe in the company. I just don't. So Bell Canadian is where we are. That's AT&T's Canadian cousin. It has a better alpha, I believe, than AT&T, which is why I got into it. Let's take a quick look. I'm curious for myself here. Let's go back. Let's see, health. Dun, dun, dun. Telcos. All right. So, first things first. The return. Verizon, right? And then Bell. So which one do you think I'm gonna pick? Let's see, volatility. All these things are about the same. Looks like AT&T comes out better, of course. I mean, it makes sense. Bell is a close second. As far as multiples, looks like AT&T has the higher multiple, which again makes a lot of sense. The dividend is about the same. Bell is a bit cheaper than AT&T, which is great. Verizon's really cheap right now. CTL has always been cheap, dividend way up there. But look at the past performance. I mean, in the volatility, I don't know. I mean, before I got into something like that, I would definitely want to see, okay, so what is the short interest like? You know, how many people are short this thing? Is that why there's so much volatility? What's going on there? All right, Bell Canada, net profit sliding a little bit. I haven't listened to the new earnings call. It hasn't come out yet, but the last one I listened to, They talked about bringing in more people for their TV service, and they actually completed some projects in one of the territories in Canada. I forget which one, but that one is supposed to bring on new subscribers. But for right now, their biggest thing is trying to get as many people signed up for their TV service. I mean, they're just like AT&T. Current ratio, all these are going to be fairly low. I mean, these are basically utilities. They run on loans. It's just the way it works. And when rates go up and they have to renegotiate their loan contracts, they lose a little bit of money that way. But they're okay. I mean, Bell's current ratio is higher than AT&T. Look at this. Verizon has all this cash. Okay. So here's the question. With Verizon losing so many subscribers, right? They're losing all these subscribers. Their business, they have to believe, is going down the tubes, right? Who can they buy to revitalize their company? Who can they bring in to rebrand themselves into something different? I mean, I think, is Verizon the one that says, "Can you hear me now?" Right? I think or is that Sprint? I forget. But the point is, they have to do something. I don't know why anyone would go to Verizon. I don't understand it, right? So they have to bring in something. And I'm not surprised if they don't hook up with some sort of internet deal. Maybe satellite internet, or maybe some type of, internet TV or something like that. They have the cash to do it for sure. All right, Bell adding assets. We like to see that. Their cap costs is a bit high. It's okay, not terrible, but you definitely don't like seeing that in a sector that basically uses a lot of loans and whatnot. Beta, really good beta, better than AT&T. Let's see here. I got an estimate on it at 41, which isn't great because I need this thing at 45. The high target is 47, low is 36. You know what? I wanted to go down to 36 because I can't do a whole lot at 47. So, but it scores the best. And honestly, I forget exactly what the score is at the moment, but I think it's beta versus something. I could be wrong. Anyway, let's see here. All right, 26% off is high, 23 off is low. So I was wrong. Bell Canada has a lower alpha than AT&T. And yep, 69% time versus 23. I'll have to look at the scores again. All right, so that's telcos, 0.26. All right, utilities. Utilities are one of those sectors that's kind of like consumer durables, where they're going to make cash. There's no question about it. Everyone uses gas. Everyone uses electricity. That's just the way it is. The company that we're in is Excel Energy. They are the largest energy provider in the country. And looks like their performance versus their peers comes in a strong second here. For February, they did drop a bit, but not a whole lot. Not compared to the rest of these guys. Let's see. The average is 2%. Excel only dropped less than 1%. I can be happy about that. I can definitely be happy about that. I own this one in my personal account as well. I'm just collecting dividends on it, honestly, and waiting for price appreciation because it's gonna happen. It's going to happen. Just waiting on it. All right, so that's that. Let's see. Do I have this one done? No, I don't. I don't have this done. All right, well, let me do this, and you guys can hang out with me. Well, actually, no. I'm gonna take a bite of my sandwich and get back.